Well, good afternoon or good morning, depending on where you are joining us from today. My name is Leah Singleton, and I would like to welcome you to today's webinar. I'm joined by David Whaley, and today we will cover aspects related to employee stock ownership plans. This webinar is the first in a series of 5 webinars slated every Thursday at noon for 5 weeks. Each webinar will explore a different benefit-related topic. Please join us every week or just for the topics of interest to you. You can register for additional webinars through the invitation you received. You can also apply for CLE or HRCI credit for today's webinar. There is an attorney affirmation form in the handout section on your screen. We will give you a code that you will need to complete the form at the end of the webinar. During the webinar, please feel free to use the question panel at the upper right-hand corner of your screen to submit questions. We will answer questions at the end of the webinar as time allows. Any questions we do not answer during our time together today, we will respond through email after the webinar. And with that, let's get started.
Yeah, thanks so much, Leah. This is David Whaley. I'm a partner ostensibly in the Cincinnati office, but I work pretty much around the nation with respect to specifically the topic we're talking about today, employee stock ownership plans. I think it's important to note, I always like to make sure everybody understands this. It's employee stock ownership plans, not employee stock option plans, because the option plans are a little bit different universe and a little bit different space. But my practice is not just ESOPs. My practice includes full-scale employee benefits, as does Leah's. And so we are full-scale employee benefits attorneys. I spend about 50% of my time, though, working with ESOP-owned companies and working in transactions with companies that are undergoing ESOP transactions, where you have a selling shareholder or shareholders that are selling the company to their retirement plan. So we're going to talk a little bit today about what that looks like, what a transaction looks like, and what potentially whether or not it's an option or an idea for you, for your company, for a company you own.
Right. So today's session will cover just some basic questions you may have about ESOPs. First of all, what is it? And how does it transition share ownership to your employees? How does it work for retirement? And should an ESOP be part of a business succession plan or exit strategy? What are the tax benefits of an ESOP? And when does an ESOP make sense? So first, what is an ESOP? As David said, an ESOP stands for Employee Stock Ownership Plan. So an ESOP is a retirement plan. It's very similar to and governed by the same laws and regulations as a 401k plan. But there are some very distinct differences. In a 401k plan, we're familiar with that structure. Most of us have a 401k plan. We make contributions to the 401k plan on a pre-tax basis. Our employer may match those contributions or make contributions themselves. And when we can invest our accounts in a menu of mutual funds or other investment options. When we terminate employment or when we retire, we get to take that money, usually as a lump sum. So an ESOP has some differences from a 401k. Mainly, employees do not make contributions to the ESOP.
Yeah, typically. I mean, so we end up sort of seeing that sort of 2 veins, and we're going to show a slide in a second with a lot of companies that have ESOPs, and they're really different forms of companies. There are some that are, and if you look at that last bullet point, really important, the ability to borrow, because that drives at this. There are some that Leah talked about that employees typically don't make contributions to them. They're profit sharing plans that fund the purchase of stock over time, so participants can get ownership in the company with the profit sharing plan over time. But secondarily, the other type that we end up seeing is that it's really a stock fund within a public company's retirement plan, a public company's 401k plan. We're going to spend most of the time today talking about the former, talking about those sort of the private companies that have levered up to as a business transaction strategy or transition strategy to buy the stock of the employer. But realize that it does cover both kinds. It covers the 401k investment fund that is allowed to invest in stock of a publicly traded company or privately, but oftentimes publicly traded company. It also covers the privately held company that's looking for a business transition plan and an owner that's looking for a business transition plan. And the reason why an ESOP becomes so particularly special is that last bullet point. The ESOP, unlike any other type of retirement plan, has the ability to borrow money to buy the stock. And since it has the ability to borrow money to buy the stock, the future earnings of the company then go to his retirement plan contributions to the plan, have the ability to pay that loan off. And so that's the really unique factor that we have in an ESOP world that is not just a public company stock fund.
Absolutely. Uniques have a very unique structure, and there's really no other comparable plan that enables a company to provide such unique benefits to employees. An ESOP's invested primarily in employer stock, whereas a 401k plan usually has a vast menu of different kind of investment funds. So what kind of companies have ESOPs? ESOPs, a wide variety of industries use ESOPs, but you tend to see them more for companies that provide services or some type of manufacturing companies. Some of the most notable majority-owned, employee-owned companies with ESOPs or a public supermarket with 200,000 employees in their ESOP. The maker of Gore-Tex has over 10,000 employees in their ESOPs, and there's many other type of employee ownership plans that account for well over half of Fortune magazine's 100 best companies to work for in America year after year.
And I think it's important to realize that of that list of companies, there's both companies that are what we talk about, that 401k having a stock fund, and companies on that list that were privately held companies that were sold to their employees through a retirement plan.
And the other unique thing about an ESOP is you can have it in conjunction with the 401k plan, and usually there is a 401k plan that goes with the ESOP. As of 2016, that's the most recent year that we have full data on. There were over 6,000 ESOPs in the United States holding assets of nearly 1.4 trillion. That's trillion with a T in dollar amounts, and over 14 million participants.
Well, and it's interesting, we're actually seeing it right now, a decrease in the number of ESOPs because we see so much consolidation generally. And so we are actually seeing a decrease in the number of companies. And so therefore we are seeing as well a decrease in the number of ESOPs. We participated in a lot of transactions representing companies buying, selling, or trustees that are dealing with ESOP owned companies that are selling out.
Yep.
So we really get to this question, how do you transition to an ESOP transition to employees? So how do we really have this private transaction work? And it really comes through one of three ways. The company can literally contribute shares to the trust. So if you think about it, you have a retirement plan, the company issues shares directly to the retirement trust as a contribution. Instead of putting 3% of compensation in somebody's account and having that account invest in mutual funds, we're going to contribute stock that's equal to 3% of the participant's salary directly to the plan. We can have it set up such that the company contributes cash to the ESOP to buy shares. So we have cash that goes to the plan. It sits in the plan sometimes just that year, sometimes over a few years, to build up sort of enough corpus inside of the plan that it can then go out from the company or from a selling shareholder to buy shares directly with that cash that's in the plan. But most often when we end up dealing with private companies that have ESOPs, we have the situation where the ESOP borrows money to buy shares. And that borrowing of money ends up coming through a scenario where the company, and we're going to go through this, but the company functionally borrows money, lends it to the ESOP, and the ESOP uses that cash to then go out to the shareholders and buy shares from the shareholders. So the question then becomes, how do employees receive that stock? Well, realize that it really depends on the slide before how they receive that stock. If we're talking about the company contributing shares directly to participants, they receive the proportional amount of shares that were contributed to the plan. If I receive 3% of my compensation as a stock contribution, I have stock that's equal to 3% of my compensation that goes directly in my plan. If we use cash that's within the plan to buy stock, the amount of cash that I have that bought shares, basically we trade that cash for stock, and that's how I get shares. But again, that last allocation, that last place where we have the company borrowing, the ESOP borrowing money to be able to buy shares, is that we realistically then have loan payments. So what happens is the ESOP makes contributions to the plan, usually just like profit sharing contributions. And then the ESOP turns around and makes a payment on the loan. And as the payments on the loan are paid, a proportionate amount of shares fall down to the participant's account. And so we end up having this loan that might be a 10, 15, 20-year term, and it takes 10, 15, 20 years of contributions to the plan to have shares fall down to participants' accounts, and they receive that allocation over time. Realize as well, to receive that initial cash allocation or to receive the allocation of stock, we can put conditions. We can have a requirement that an employee work a minimum number of hours in a year, no more than 1,000. We can require an employee to be employed on the last day of the year, and oftentimes we end up having exceptions to that. If you die, become disabled, retire, we're not going to hold that 1,000-hour requirement for you. We're not going to hold the last day of the year allocation requirement for you. So it looks a lot like your matching contribution in your 401k plan or your profit sharing contribution in your profit sharing plan. Then what happens when an employee leaves, if they've stayed there long enough to become vested, they get their stock. And then the company buys that stock back from the employees at the fair market value. Now, we're going to deal with what the fair market value and the valuation metrics are a little later in the presentation. But I think it's really important on that last bullet to really think about this. If you have a publicly traded company and you leave employment, basically a portion of your 401k is invested in a single stock. You can go to the market and turn that stock into cash as you need that stock turned into cash. But in a privately held company, you have a piece of paper. Only the company can really turn that stock into cash. And so what we end up happening is that the company has to turn that stock into cash, because as much as we love the value of our companies, as much as we love our companies, it turns out that Kroger won't take a stock certificate to buy groceries for the week. And so the company has to turn that stock into cash to be able to utilize that in retirement. And so that process, we're going to talk about a little bit on the valuation and how people or participants turn that stock into cash.
And one thing I wanted to add here, when the employees receive company stock through an allocation, those allocations are subject to very similar non-discrimination rules like a 401k plan, where the allocations have to be made on a non-discriminatory basis. Most of the time, it's based on compensation, but there could be some service or another type of formula to base those allocations on.
So let's go through a pretty simple initial ESOP transaction. We end up having a company that's at the beginning owned by its shareholders, not owned by any of the employees. Now, some of those shareholders may very well be employees, but not owned through the retirement plan. And we start with 4 real players: the employer that's going to sponsor the plan, the shareholders, the ESOP itself, and the bank. What happens is the employer borrows money from the bank. The employer then sends that bank loan to the ESOP. And I missed a step. For that bank loan, of course, the bank's going to take a pledge of collateral on the employer. They're going to take a lien in the employer's assets, their accounts receivable, any real property they have. Company turns around and takes the proceeds from the bank loan and lends it to the ESOP. The ESOP then takes the cash and delivers it to the shareholders for the stock. Now, as you can imagine, a bank's probably not going to lend 100% of the value of a company directly to the employer for this transaction. So we end up seeing banks lend somewhere between 20 and 40% generally, sometimes different, to the employer. So that 20 to 40% goes from the bank to the employer, employer to the ESOP, ESOP to the shareholders. But we still have a delta there. We're still missing somewhere between 60 and 80% of the value of the company. So the shareholders often at that point also take a note from the ESOP. And so the ESOP will end up, in the scenario of the transaction, buying 100% of the company from the shareholders, 20% of which to 40% of which was paid for from the bank loan that was lent from the bank to the employer, employer to the ESOP, ESOP then to the shareholders, and the rest are just loans directly from the ESOP to the shareholders. In exchange for all of that, the employer stock goes back to the ESOP. And so we end up having the ESOP, following that transaction, own 100% of the stock. But remember, we talked about that leverage transaction. That doesn't mean that 100% of the shares are in participants' accounts. Instead, what happens is we end up having loan payments. So the company will make a loan payment. A company will make a loan payment to the bank. From the loan payment to the bank, they also will make a contribution or dividends to the ESOP. And so the employer is functionally paying down 2 spaces of debt. The first being they're paying off the bank loan, and the second is they're giving the ESOP the ability to pay off the debt that it has. Realize as well, we ended up having some loan payments potentially to the seller. The employer will also pay off those loans to the seller. And so as a part of all this, though, what happens is shares that are held in collateral, those suspense shares we talked about, then fall to participants' accounts. So we have this circle where the employer generates cash, it's making money, and it will first usually make a contribution to the plan. The plan will pay off whatever debt it has, usually back to the employer for that first loan. And then the employer turns and makes that payment back to loan payments to the bank. After you pay off the bank, the employer then provides enough money to pay off the seller for the seller portion of that loan. But only on a proportional basis as those loan payments are made through contributions and dividends to the ESOP do the shares fall down to participants' accounts within the ESOP plan. So it takes that entire cycle for 100% of the shares that the ESOP bought to be allocated out to participants' accounts.
So that's just a general typical ESOP transaction. There can be some differences depending on company and cash and loans and things like that. But that's a general way how the employee gets the shares in their account. So once the employee gets the shares in their ESOP account, they're an employee owner and they're a shareholder of the company. Now, the trust actually owns the shares, but the share value appears in the participant's ESOP account, much like a 401k account, where you have an individual account. So then the question becomes, okay, if we have all of these employee owners in our ESOP, what information do we have to give them? What financial information do we have to disclose to these employees? And how are they controlling our company? So an ESOP's really only required to disclose minimal financial information to employee owners on an annual basis. Like if we owned stock in Google, we don't have all of the information of what every single manager makes and all of their information on how much they pay vendors and things like that. We just have a general information overview of the company. So a company is not required to disclose all of this sensitive financial information to their employee owners. But the ESOP is an ERISA plan, and the company must provide all of the ERISA required documents, such as a summary plan description, a summary annual report, individual benefit statements, and things like that all retirement plans have to provide. The employee owners do not actively participate in the management of the company unless you want them to, but an ESOP does not require that. The management team continues to run the company as it had before an ESOP.
Yeah, and we get this question quite a bit whenever we're talking to clients about the beginning of their ESOP transition, the beginning of selling to employee owners, because there is sensitive information inside of a company. Sometimes there's proprietary information pertaining to what the company's operations are and the way in which the company operates that you would not have all employees understand. But more often the question then becomes is, wait a minute, does the employee that's on the factory line get the ability to set the pay that the CEO has? And I think it's really important to realize and get back to this space that the ESOP is a retirement plan. It's a trust, separate and distinct from the company. It has a trustee, separate and distinct from the company. And so the companies still run the same way it was before. The company has a board of directors. The board of directors appoint officers and set the compensation and employment in terms of those officers. And then the officers are charged with employing and engaging the process and business of the company. And the officers in employing and engaging the process and business of the company move forward. That does not mean at any level that the officers, nor do the factory line employees have the right to say what the president, CEO, other officers make. That's the board's decision. Now, I always like, and I think this is really important, then we say, what do you have to provide? Functionally, the only thing an ESOP has to provide to a participant is an annual benefit statement. That annual benefit statement is going to realistically have two things on it: how many shares are allocated to your account and what those shares are worth. So you are going to tell employees on an annual basis what a per share value is. And employees can figure out how many shares there are in the company, so they can figure out generally what the company is worth. That's the only real ability we end up having in telling employees what how the company runs on a financial basis. But I like to stop because I think it's really important to understand that employee-owned companies statistically perform better than non-employee-owned companies. Now, I always like to point out at that point, I'm a partner at a law firm, therefore we're technically an employee-owned company, and I think we're wildly perfectly managed. So therefore, I love the fact that we are more managed than non-employee-owned companies. But when we talk about employee ownership through ESOPs, really what we're saying is that we're giving not only executives, because oftentimes executives will have equity inside of a company, but we're giving broad-based ownership. We're giving all the way down to basically all full-time employees some piece of this pie. And whenever you give them some piece of that pie, they end up feeling as if they can help the company, it helps them. It's not just a continued W-2, it's also an increase in their account balance. And so I always tell employers, you do what's best for the culture of your company. But with respect to what financial information you may want to display, it may very well be important to provide pretty basic but potentially helpful profit and loss statements to participants on some level basis. And I use an example of a co-speaker that I had once, oddly enough, on a health and welfare topic. Always love to tell people, again, I'm a full-scale employee benefits attorney. That means that I do some Affordable Care Act work as well. And during the time of the passage of the Affordable Care Act, we were educating ESOP-owned companies specifically on ways to think about compliance with the Affordable Care Act. And what this client said, and I love this aspect, is this client has a quarterly meeting with their employees where they provide a profit and loss statement to all the employees. And that profit and loss statement they provide to the employees, they've educated how to read the profit and loss statement. And the employees figured out that their second highest cost after payroll was healthcare. And so they figured out that since their second highest cost after payroll was healthcare, that they could find a way, it was a self-insured plan. If they could find a way to lower their healthcare cost, they'd make more money. Now, the employees were also making a little bit more short-term money here because the employees were not only incentivized to increase the value of their stock, but they received a quarterly profit-sharing amount directly to them in their pay for increases in profitability. The company then instituted a wellness program. The CEO referred to it as the No Lay's Potato Chips wellness program because for him to pass his cholesterol test, he had to lay off his Lay's potato chips. And ended up saving over the year $1.5 million a year, if I remember correctly, on their healthcare cost. And so you can end up seeing that by displaying the correct financial information about the company to the employees who benefit directly from the growth in the value of the company and the decreasing of cost in the value of the company, we really can have a direct correlation to the increase in value of the company. Now, that's not every culture, and it's also a very detailed space of limited financial information to employees. You don't have to provide that, but you can see how an employee-owned company can really drive value by providing the right information to employees on a pretty regular basis.
Yep. ESOP companies often have these ownership cultures that encourage employees to think and act like owners, just like David said. So while it's not required to give all of this information, oftentimes it's very helpful for the employees to contribute to the bottom line. Research shows that ESOP-owned companies are more productive, they're faster growing, they're more profitable, they have less turnover, and they generate more wealth in a retirement plan. And that's just because of this think and act like an owner culture that ESOPs have. There was a study back in 2000 that found that ESOP companies grow around 2.4% faster than they would have grown if they had not put in place an ESOP. So this mentality that these participants that have a retirement plan, instead of looking at the stock market and seeing how the stock market impacts their retirement plan every day, they look around and are like, oh, I'm on the factory line. Let me cut waste. Let me pay attention to the little widgets I put into this thing I'm making, and it encourages just growth of the company. So how does an ESOP work as retirement for employees? So we've talked about how the employees get their shares through some structures with loans, and then it's allocated down to the employees, usually based on their compensation. So the higher paid employees typically get more shares than the lower paid employees. But then how do they actually receive retirement from this ESOP? So like we just said, research shows that retirement benefits are typically larger in an ESOP space when compared to other types of retirement plans. Now, since the majority of the retirement is invested in company stock, a lot of people, when they're thinking about putting in place an ESOP, wonder if this is really too risky to be a good retirement plan for employees, since the retirement is concentrated in employee stock. And these people are also getting their paycheck from the same company that they have their retirement stock invested in. So they're not diversified at all. But research has just shown that retirement accounts grow faster, and there's more wealth to be distributed when you have an ESOP.
And we're also seeing, and I think this is really important to think about what the diversification is that we end up seeing generally employers have what we call a safe harbor contribution to a retirement plan. Is about the level of contribution that companies, especially in the small capitalization space, have. And so that's a 3% non-elective or a 4% match is what it really ends up being. Sometimes both of those. So you're talking somewhere between 3 and 6% of compensation as a retirement contribution. A lot of our ESOP clients will actually continue to maintain that retirement contribution to a 401k plan to allow individuals to diversify their retirement funds and then provide the ESOP as an additional benefit. And they provide the ESOP as an additional benefit because we'll talk a little bit about this, but some of the tax advantages that exist for selling shareholders on exiting their companies in that timeline. And so you end up looking at, yes, there is some concentration of W-2 and retirement savings in the same basket. But if we add a basket next to it that looks an awful lot like the basket of every other employer, there really isn't a concentration. It's just merely a net benefit to the employees.
Mm-hmm. So when an employee leaves, terminates, or when they retire, the amount of stock they receive depends on how much stock was in their account. And then a layer on top of that depends on the vesting schedule. And if you're familiar with 401k plans, the vesting schedules that are permitted for an ESOP look very much like the vesting schedules that are permitted for 401k plans. A 3-year cliff vesting where you're not vested at all until you work 3 years. Typically, a year of service is 1,000 hours of service during the year. And then there's a gradual vesting for a 6-year gradual vesting scale. Now, companies can always be more generous and always do a different type of vesting schedule, but these are the outer limits that are provided in the code. So when an employee leaves the company, the employee receives the percentage of their vested stock. And then, as David talked about earlier, they have these stock certificates that they can't go and buy groceries with. They can't turn into the cash. So the company must buy back these stock certificates from the employee at its fair market value. So what is the fair market value? How much is the ESOP stock worth? Well, private companies have to have an annual valuation done every year, and it has to be done by an independent third party. If it's a public company that's traded on the stock market, then the price on the stock market is obviously the value of the share. These annual valuations are also used to give the annual benefit statement, as David alluded to earlier, where participants get an annual statement. You have X number of shares in your ESOP plan. You are blank % vested, and the price per share is this amount. So the employee can see every year exactly what the dollar amount could be once they leave the company.
Yeah, and I think it's important to realize that the way the process for private company valuation is done, interestingly, not realistically different than what we see for non-ESOP companies, although we do end up having an annual requirement. And so the trustee has to engage for a non publicly traded company, has to engage a valuation firm. And that valuation firm has to be independent, and they have to be an expert inside the field of valuating companies. The trustee typically interviews a few individuals who are good valuation firms with respect to that specific company. And if you think back to the slides we had before, a lot of times this is industry specific and trying to make sure they have sufficient data inside the industry to demonstrate what the value of the company is. That valuation firm interviews and talks with the company, talks with the trustee, and figures out what they think the forward profits of the company will be. They use the historical information and historical practices of what the company has done to justify the forward. So if the company says, we really believe we're going to hit it out of the park, we're going to double revenue and triple profitability, the valuation firm may have a little bit of a question pertaining to relying on that whenever the historical has not been in line with such a space. But whenever we end up having valuation firms that look back at the historical and see that the projections look in line with what the historical is, or there's a reason for an increase because there's an acquisition, there was a new line of business that started, they utilize those forward projections and they come up with a valuation methodology to figure out what the value of the company is. One of the ways they try to, this is not a valuation presentation, but one of the ways they look is they look at the marketplace. The best way to figure out what a company's worth is what it buys or sells for. Well, for a smaller company, it's not as if we have a large database to figure out what it buys or sells for, but we look at the public market comparables to the extent we can. Try to look at private company transactions to the extent we know. Then also looking at what that forward valuation is. What do those projections show? And if we do a discounted cash flow analysis off those forward valuations, we try to figure out what the value of the company looks like. And you take those three spaces, those three spots, and sort of put them together to figure out what we think the value of that company is, the valuation firm. The valuation firm delivers that to the trustee. Now, the valuation firm does not actually determine the value on an annual basis. The trustee does. The trustee relies on the valuation firm. And so the trustee then at that point has to kick the tires on the valuation report. They have to make sure they understand. They have to make sure that they look at and figure out what that valuation report says. Now, why is this really important? And I think we get to the next slide a little bit, but it's really important because that valuation is utilized for two purposes. First, to tell those employees on the statement, hey, your share is worth X, so people can plan for the retirement, so people can feel like they really are driving the forward value of the company. But second of all, we use it for distributions. We use it to figure out how much and how we're going to pay out those participants. Because again, as we've said, you can't take that stock certificate to the grocery store. You've got to turn that stock certificate into cash.
Yep. So the distributions from an ESOP timing is different than the distribution on a 401k. If you're in a 401k plan, generally when you terminate or when you retire, you have access to your account immediately. You can take it out the next day. You can take the money and hit the streets with it. In an ESOP, that does not have to be the case because the company has to give the participant cash in exchange for the stock. The rules that regulate ESOP allow the company some planning time to plan and to get that much cash, so to speak. So there are some additional rules to the distributions from an ESOP that are different from the distributions for a 401k, and really practically they're there to allow a company to plan for it and get the cash so they can buy back large account balances from participants.
And I think, and not to interject, but I think it's really important to realize these are distribution rules for non-publicly traded stock companies.
Correct.
Because if you think about a publicly traded stock company, it's not different than your 401k. You can go to the market and sell the stock in the market and turn that stock into cash. So we end up seeing those do not have the limitations. We end up seeing those typically allow for distributions immediately upon termination or administratively as soon as possible following termination. Inside of a private company ESOP, that's where we get to those special rules we need because the company turns that stock into cash and the company needs the tools and the time to be able to plan to turn that stock into cash.
Yep. So this slide summarizes some distribution rules, and they get very technical, and we're not going to make your eyes glaze over by going through all of those technical rules today, but just kind of realize that if the reason for termination was normal retirement date, disability, or death, the distribution starts sooner than if it's termination for any other reason.
But realize one, and I think this is really important. So people that are above normal retirement age, typically above 65, people who are disabled or die, they still have to wait until the next year. Mm-hmm. It's not just January 1st of the next year because we talked about the valuation process. So let me run through a particular calendar that can cause some challenges in communicating with employees and for employees to think about with respect to their ESOP benefit. Somebody terminates employment after retirement. January 15th. We always say, why would you terminate January 15th? Maybe I wanted to make sure I got that last allocation, because we were talking about the way you get contributions into the plan. I'm going to get my full allocation. I'm going to have a share release from that allocation, and then I'm going to terminate in January. Well, I'm going to get an allocation for, let's say it was January 15th, 2019. I'm going to get an allocation for January 5th, or pardon me, for 2018, December 31, 2018. Well, we have to figure out, so I get my allocation. Then we have to the trustee has to bring the valuation firm in. And the trustee's valuation firm has to figure out what the stock is worth. And then they communicate it to the trustee, and the trustee announces it to the employees. So we're probably already 4 or 5 months after January 15th that I terminated employment. But I don't get my money on that moment because I have to wait until the end of the next plan year. So I go all the way to December 31, 2019 to January 2020. And you think then January of 2020 I should be able to get my money. No, because we have to go through that same process we just went through to be able to determine the value of the stock by the trustee through the valuation firm. So if for a person that terminates in January 15 of 2019, it might be June or July or August of 2020 before they get their forms telling them what their stock's worth, before they get the opportunity to elect. And then 30 to 45 to 60 days following that form, do they get cash back from their distributions. So even in the event of death, disability, and retirement, it can be a long window before a participant can actually terminate and get payments from the retirement plan. Secondarily, if you look on the slide, distributions don't have to start for 6 years following termination. It's functionally five years following termination. It's the 6th plan year after termination for anybody who doesn't terminate because of death, disability, or retirement. So if you have a 45-year-old, they can't go, you know what, think this is our highest year, I'm going to go ahead and quit so I can get the stock at the highest price. The plan's allowed to be set up so they stay in stock for 5 years following termination before they even get offered the chance to take the stock out as a distribution. And so it really protects the company in 2 ways. It allows them to really have the timeline to make sure a bunch of people don't run away. And even in the places that's the fastest distribution spots, they have sometimes up to 16 to 18 months to figure out how to turn that stock into cash from a person who terminates because of death, disability, or retirement.
And then to even delay that even further, if there is an ESOP loan, there is an exception that an ESOP plan can take advantage of, so that if the shares were bought by a loan that the ESOP is still paying the loan payments on, the start of distributions can even be further delayed until the loan is fully repaid.
Now here's the fun catch on if you want to flip to the next slide and then we'll go through. Basically, we're talking about once you get paid, you think, okay, the company's got to come up with cash. Well, we actually even have another exception that says that once you start your distributions, the company, if they need to, and if they have the ability to say, we'll pay you out over 5 years. So we can actually turn that stock, we can make a regular 45-year-old who terminates employment, wait 5 years, and then pay them out over 5 years. And so this really speaks to us from 2 spaces. It speaks to us, first of all, because for companies that are concerned about cash flow issues and turning that stock into cash so people can go to the grocery store with retirement, it gives them the flexibility to be that company, the flexibility to be able to generate enough cash to pay off this stock, this liability. But secondarily, what it says to the employees is that, hey, while this is a fantastic benefit, it's not a tomorrow benefit. And this, to me, always leads to my recommendation to clients to say, you probably want to have a 401k on the side. Now, we talk about all this and we deal with all this, but what we end up having as well is that we have an employee who terminated employment at 45, and it might be 5 years before they can get to their money at all, and it might be an additional 5 years before they get all their money. What are they doing with their cash during that time? Well, typically it's invested in company stock. So now you have this employee who's no longer your employee, hasn't been here for 7, 8, 9, 10 years, that's still getting the increase in value because we're doing fantastic as a company. And so what happens with a lot of my clients is a lot of my clients want to end up finding ways that they can otherwise try to turn that stock into cash faster than 5 years. They try to turn that stock into cash faster than paying it out over 5 years. And so we have some tools that if the company has enough cash, we can turn that stock into cash faster so that those terminated employees do not get the run up in value that they didn't participate within. So we have some flexibility to do it faster. We also have the tools that are available to make it a slow process to make sure the company can cash plan to be able to get that stock into cash over a longer period of time.
And there's also some flexibility for small account balances to be paid out faster in this time period as well.
So we've talked some about the mechanics of what an ESOP transaction looks like. We've talked some about what the mechanics of the way an ESOP operates or is administered. What we want to talk about is whether or not an ESOP is part of a succession plan for you or your company. Is it an exit strategy? So talking a little bit about ESOPs as a succession plan. Why would you end up having an ESOP as a succession plan? Realize that they create a ready buyer for your company's shares. That ESOP and the ESOP trustee stand beside the company and are a place to be able to buy shares. We end up seeing that ready buyer for company shares show up in companies that have a good number but not a ton of shares. I'll use community banks as a great example of a ready buyer for ESOP shares. We end up having community banks that will have 50, 60, 70 shareholders that every year probably clear 2 shareholders, and they don't necessarily have the next 2 shareholders ready to be able to buy those shares. Having an ESOP as a part of that structure, not necessarily just community banks, but companies that have sort of diffuse ownership, really ends up having a standalone buyer to be able to buy the shares of the company at a fair market value for all those diffuse shareholders. So it gives the company flexibility to manage its capitalization table in a way that really helps, that transfers the ownership to the employees and gives liquidity to all those shareholders at differing times. Realize that another reason is it gives owners flexible exiting strategies. One of the questions we can think about here is that if I have an individual who owns 100% of the company, but functionally wants to take 30% off the table, they have another investment they want to make, they may just have kids' college expenses, and they want to sell 30% of the company, so they sell 30% of the company to the employees through an ESOP. It lets that selling shareholder liquidate a portion of the company without selling the whole company, in a way that then gives it to the employees and quantifies it so that that money can come back to the shareholder in a way that can let them invest in something else. It gives the owner a fair market value without letting it sort of disrupting the company. We end up seeing this with respect to a lot of transactions, that whenever you have a merger and acquisition activity inside of a company, you end up in a space that actually, I'm trying to say this as right as possible, you end up in a space where the company ends up not performing as well during the merger and acquisition because so many employees are being so asked to multitask, are being asked to go through various challenges. In that final bullet point, I think this is really important. Selling more than 50% does not necessarily mean that you have to relinquish operating control. I think it's important to realize that doesn't mean necessarily that you have the ability to appoint the board continuously. It doesn't mean that you have the full ability to be able to run every day of the company. What it really means is that that a lot of times selling shareholders have run their company their way. And they've run their company not meaning that they really have this view of the way the company fits in with the community. And by selling even more than 50% of the company, it means that the legacy that a seller has can continue to have the impact on the community, such that the company can be operated within their continuous community. And it can be a legacy footprint for the family, for the company to be able to operate forward. So as opposed to selling to a strategic purchaser, as opposed to selling to a hedge fund, it lets them have some ability to say what the legacy of that company is on a forward basis. Realize there's succession tools as well. They can protect the owner's legacy, as I just noted, in their heritage. You can use corporate tax gains to invest back in the company. One of the things we're going to talk about in a second is that ESOPs can be very, very tax efficient, both to the selling shareholder and to the operating company. An ESOP can be an S corp. An ESOP can own an S corp. And if you think about an S corporation distributes on an annual basis a K1 to all of its owners. And the K1 it distributes to all of its owners is the profits. And it tells the owners, regardless of whether they got cash distributions with respect to those profits, it tells the owners, you owe tax on this much money because the company the S corporation made this much money. Well, when an ESOP is a shareholder of an S corp, it receives a K1, but it's a tax-free trust. And since it's a tax-free trust, it does not have to pay taxes on that money. Well, whenever you have individuals who own shares of S corporations, either they have sufficient cash of their own to pay their taxes, or more likely the company makes a distribution to the shareholders sufficient for them to pay their taxes. So you end up having a drain of cash from that corporation for those individuals to be able to pay their taxes. But if some or all of that profit portion goes to a tax-free entity, there is no need to make a distribution to the ESOP to be able to pay its taxes. And since there's no need for the ESOP to be able to receive a distribution to pay its taxes, that what ends up happening is the company has more cash on its balance sheet. Well, the more cash on its balance sheet, we'll see in a second, can be utilized to pay off the selling shareholder faster. It also can be utilized to invest back in the company to increase growth. So if there's a company that has a real strong desire to be acquisitive, we want to generate cash to go out and buy a competitor. Maybe we want to build cash to go out and put a new line in our business. Maybe we want to build cash to be able to, for other capital expenditures, to get into a new line. An ESOP-owned company has that extra cash because there's not the bleed of tax distributions. It also lets them accelerate their debt repayment. We end up seeing succession tools because there is pride of ownership, and we also see that ESOPs can be used as fantastic recruiting and retention tools. One of the things that ends up happening in trying to bring an employee over is you show them your benefit package. If you can also show that employee what a forward-looking ESOP allocation looks like at retirement, oftentimes they will end up having a larger retirement benefit in an ESOP-owned company than in even public companies that have defined benefit pension plans. And since they end up having more benefit here versus there, you're able to bring them over a little bit easier.
Exactly. There's just a lot more money to be spent back on employees or growth of the company or expansion of the company if you're not paying that to the IRS. Which brings us to, what are the tax benefits of an ESOP? Now, these can get very complicated. So this is just intended to be a very broad overview today. But the contributions of stock or cash to the ESOP are tax deductible. The company is making a contribution to the ESOP, much like it makes a contribution to a pension plan or a 401k plan, and those are tax deductible. The ESOP loan principal and interest payments are tax deductible. These rules get a little bit more complicated, but basically, when the ESOP takes out a loan to buy company shares, the ESOP's loan principal and interest payments that they make on that loan generally are tax deductible. There's a little bit different rules depending on if you're a C Corp or an S Corp, but generally the payback on that loan is tax deductible.
So what really ends up happening when you think about it is whether it's an S Corp that is receiving a K-1 for 100% of the profits of the company, if it's an S Corp, the minority-owned ESOP that's receiving a K-1 for some portion of the profits of the company, or if it's a C Corp that has a corporate level of taxation but a very high deductibility because of contributions that are being made to the ESOP, you have a company that runs more tax efficiently than it does its competitors. And so the question then becomes, and we talked about this a little bit, what do you end up doing with respect to that ESOP that functionally is tax-free or really close to tax-free? Now that does, and it's really important, that does not actually impact the valuation of the company, because valuators, whenever they realize, a valuator's baseline of what a company's worth is what somebody else is willing to pay for it. And you have to assume whoever's going to buy a company is going to pay taxes. So they're going to do what we call tax affect that company's value to make sure that whenever you tax affect that company's value, you end up having a proper valuation. So the fact that the company may be operating tax-free or close to tax-free does not impact value, but the company's still generating more cash. Well, if we think back to those first slides, when you generate more cash, you end up owing the bank and you end up owing selling shareholders for that acquisition loan. So the company is able to actually generate more cash to pay back the bank faster, to pay back the selling shareholders faster. So if we think about this, and I think this is really important to sit down and think about a selling shareholder who's looking at the 5 management individuals, the staff that has really helped that selling shareholder, helped her build the company. And as she sits there and looks and says, I want to sell to those 5 individuals that really helped me build this company, but the company's worth a good amount of money and they don't have that much money. So if I sell to them on a note, I take notes back from each of them. The only way they can pay me back is for the company to generate money, them to pay tax on the money the company generates, and then pay me back on my note so that those individuals can own the company. Well, if you realize inside of that scenario, those 5 individuals that are going to take the company over from our selling shareholder, they have to pay tax before they can pay the selling shareholder back. So instead, what she could do is sell to an ESOP. And when she sells to an ESOP, what happens with respect to that company is, yes, those 5 individuals do not end up with 100% of the company, but they're the largest earners in the company. And again, we talked about shares are generally allocated based on compensation compared to other employees. So they end up with the largest allocations of shares inside the company. And as they end up with the largest allocations of shares inside the company, they often do pretty well. But the selling shareholder, for her to get paid back, she does not need to have taxes paid by the selling share by the participants or those 5 individual shareholders, but instead she has the ability to take all the pre-tax money out faster to get herself paid back faster. So we end up seeing models that go, if you have a leveraged buyout to executives, it takes about 15 to 20 years to get paid off. And a leveraged buyout through an ESOP takes about 7 to 10 years to get paid off. So the real benefit of a tax-free entity for a selling shareholder is you get paid back faster whenever you're selling to your management team.
So on top of that, when a seller sells their shares to an ESOP, that transaction can be structured under a special section in the Internal Revenue Code 1042. So that seller can then take the proceeds they made from selling shares to the ESOP and roll it over into certain other securities and not have to pay taxes on that. So there's some complicated rules for that to actually work. But so not only do you have in this situation where a company has some tax-free earnings and extra cash, the seller actually has some tax-free proceeds as well.
And honestly, the way I always explain this to people, and I think this is really important, it's very, very similar to a 1031 real estate like-kind exchange. It was put in the code in the place that like-kind exchanges were. So if you think of a farmer who has 160 acres, sells the 160 acres and buys 300 acres of a similar value further outside of town, they're able to not recognize gain on the sale of that 160 acres and roll that money into the new purchase price. Here we have the same thing. If a seller meets these rules but then sells to an ESOP, they're able to take those proceeds and invest in what we call qualified replacement property. And whenever they invest in qualified replacement property, the basis that they have inside of their stock transfers to the new purchase, and that transfer then keeps them from paying capital gains on the sale. The perfect scenario, I'm going to skip ahead, is that the perfect scenario, we'll come back, is that we end up having a step up in basis for the individual's assets that's purchased. So if the selling shareholder takes their proceeds, invest in a product or in a security they're going to own for a long time, and there's some specialized products in the market that are sold for this, and then dies while still holding that product, they actually get a step up in basis with respect to that product and functionally can sell their entire company to their employees capital gains free. Let's step back one slide because I think this is important. We end up seeing one of the other parts of deductibility or tax efficiency for an ESOP is that the dividends are tax deductible. I think it's really important to understand what this is because it's a C Corp scenario, first of all. And in the C Corp scenario, first of all, is that it's dividend deductions to a C Corporation. We don't have dividend deductions on an S Corporation. There are no dividends. But dividend deductions to a C Corporation mean that dividends paid on stock that's held within the ESOP, there's actually a deduction to the corporation under Code Section 404K. This is one of the largest drivers we see for companies that either are public or have a diverse ownership space to be able to generate tax deductions for the corporation while still getting shares in the hands of employees. Let's take XYZ Corporation, which is a publicly traded company in Atlanta. XYZ Corporation has a 401k plan, and they set up a stock fund within the 401k plan. And that stock fund over time ends up investing in 15% of the company. Well, XYZ Corporation pays $1 dividend a year. So with respect to the $1 dividend that's paid to the 15% of shares that are owned by the ESOP, that corporation is going to get a deduction under 404k for the dividends that are paid to the ESOP. That's probably the number one driver that we see for public companies having ESOPs and stock funds. And it's very important because those are literally required to be ESOPs. They're not just stock funds that are invested in employer stock. So when does an ESOP make sense? Getting to the end here, we end up having a C Corp or an S Corp of a closely held company. Really important, not an LLC. LLCs are going to need to convert to a corporate form to be able to do an ESOP. And so LLCs, honestly, probably LLC's taxed as a C Corp or an S Corp, or LLC's taxed as a partnership. You really need to convert to corporate form. You need sufficient debt collateral. Realize we talked about the bank. The bank has to have something to loan against, and either that's a hard asset or it's a good amount of accounts receivable. You want to have the right culture that employee ownership is going to work. If a company has been ruled with a sort of iron fist top down, it may not be the best culture for employee ownership. Typically, you're going to have about 25 employees, not a hard and fast rule, but a general idea. There's some non-discrimination rules that keep concentration of employee ownership through ESOPs to a diverse group. Realize, again, it's not selling to a person or a small group of people. It's selling to a broad-based group of employees. You want a good history of cash flows for several years. We don't want companies that have highs and lows where they end up hitting negatives, but you want companies that generally generate reasonable and relatively predictable cash. And again, anticipated future revenues. When does it make sense? Whenever we have a company that really needs the tax advantage financing. We have companies that are, for whatever reason, desiring that high increase in savings resulting from an ESOP's ownership. You'll end up seeing this sometimes with companies that really are looking to grow and make really strong investments, but don't necessarily have the current cash to accomplish that. We take away the tax cost of running a company. They may end up having a very, very strong ability to move forward. 100% owned ESOP F Corps are perfectly tax-free. Realize that, again, that selling shareholder is going to get their cash quicker from a tax-free entity. And on top of which, a company that's looking for, and I've done a couple deals in this space, something extra to talk to their employees. Why do you want to come work for us? Why do you want to stay working for us? Again, the challenges. ESOP structures can be very complex. You need an increased number of service providers, and they're more costly to maintain than just maintaining the company. But I always talk, and I think this is really important. You know, the family-owned company that grandpa owns and the grandkids participate within and the kids participate within, they have ownership challenges. They're typically family challenges, though. And so they gather, I always say, the Friday after Thanksgiving and meet. They don't quantify the cost of that challenge, though. And so realistically, what we're doing is we're taking what is oftentimes a family or a partnership cost and transferring it onto the service providers in the ESOP. And so, yes, it is more costly to operate because there are extra plans, extra audits, extra work than a typical retirement plan. But if you include the cost of ownership inside of the cost of running the business for a privately held company, a lot of times they end up being cheaper to run because you don't have the estate planning challenges and the family challenges that we end up running across with respect to some family-owned businesses.
Plus all the tax savings.
Yes.
And repurchase liability can be a disadvantage long-term. Repurchase liability is what we call when the company has to buy back the shares from the employee. So if you have a couple of your top management team that has huge ESOP account balances all retire within the same year or within the same 2-year period, that cash flow that's needed to buy back the shares from a large group of people retiring at the same time, it just needs to be planned for. And there's less diversification of retirement assets in the ESOP for employees since it's all in the company's stock. So that concludes our presentation for today. And for those of you who need the code for your form for your